Hello and welcome to Ushering Success. Today we'll discuss another probable GD topic for the upcoming B School GDPI sessions. And this topic is, will reduction or softening of interest rates boost Indian economy? Now, we have to understand what is interest rates. Interest rates are the rates charged by bank to its customers. Now, there are two types of customers that the banks have. One are the borrowers who borrow money from the bank and invest. So they borrow in the form of loans, which can be home loans, car loans, or commercial loans, and they invest that money to either buy a property, buy a car, or invest in their business to grow the business. And the second type are the ones who are savers, and they typically save money in the form of fixed deposits or any other kind of deposits, recurring deposits or any other kind of deposits. And their main purpose is to save. Now, how does the bank operate? The bank charges an interest to the borrowers, and the borrowers pay back the money with an interest. And the savers, they are depositing money in the banks, and the banks will pay them an interest. And obviously we can understand that the banks operate by the difference between these two interest rates. So the interest that they charge to the borrowers is higher than the interest that they would offer to the savers. This is lower. And the interest rates are governed by the RBI. They set limits on the maximum interest that the banks can charge to the borrowers, and hence that indirectly dictates the interest that they are going to give to the savers. So this is how the interest rates are governed by the banks and regulated by the banks. Now, what is the impact of interest rate on economy? How does interest rates relate to the economy? Now, when the interest rates are lowered, what happens? The assumption is that people will borrow money and they will invest. And when they invest or spend or invest. So when they spend or invest, that means the demand for goods will go up. And when the demand goes up, then the prices will go up. And when the prices go up, the suppliers will have incentives to supply more. So supplies will eventually go up. This will happen in the short term. And the supplies will go up in the mid-term, because suppliers will take some time to respond. They will have to invest in their capacity building, in their hiring of people, but eventually supplies will go up. And because supplies will go up, so they will have to employ more people. The suppliers will have to employ more people and labor, so employment will go up. And therefore, the economy will produce more goods and services. So the economy will grow up. So this is the logic with which interest rates are lowered. But does that really happen? Now, in order to understand this, we have to understand the mindset of the consumer, the Indian consumer. Now, how does he handle money? Now, if someone has money or gets money in the form of salary or wages, what will he do? He will spend some amount of it to meet his requirements, his food, clothing, shelter, and other requirements, so basic necessities. So he has to spend a minimum amount in order to do that, to meet his expenses. And then he will save a portion of it to ensure his future. He will save some amount for his future, because typically he has to meet expenses of important events in his life, like child's marriage or education, or meeting medical expenses for his parents and all of that. So he will start saving some amount of money, and if he is left with anything else, he will invest. He will invest for um, growth of his money. He can invest in a house. He can invest in cars. He can invest in other businesses. So he can invest his money, and this is for short-term goals, short-term to mid-term goals, and saving is for long-term goals. Now, we have to understand what is the order of priority of these three ways of dealing with money. The first priority is to spend, because this is now, this is current, and he has to meet his current requirements. Now, his number two priority is to save for his future, because in India we don't have any kind of social security, especially after retirement. So every Indian has a very strong sense of saving mentality, because we have to meet the requirements at different stages in our life. There are events like our child's higher education or marriage, or preparation for um, our old age. So for all those things, we have to save money. So saving comes second, and investment comes third. That is why when we see that there is an economic crunch, we tend to defer our investments, like buying a house or buying a car or things like that, and we ensure that we save enough for meeting our future goals. So this is the order of priority or importance of these three ways of handling money by the Indian consumer. And therefore, what happens is, when interest rates are lowered, then the the interest rate of savings is also lowered. And as this is lowered, the Indian consumer will try to save more, because he wants to ensure that he has enough corpus when he is old. So his tendency to save more will increase, and his tendency to invest will decrease. So he will defer buying a house or a car or things like that, and he'll ensure that he's saving enough to meet his future goals. And there is another factor that impacts his saving, which is the inflation. Now, we have to understand this also in this context, because this is an important criteria that decides the savings. So the inflation rate is typically around 5% in India, and therefore, if you save money in a bank which offers interest at around 5 to 6%, then effectively you are not able to beat inflation. Your effective uh, increase in the value of the money is the difference between the saving interest rate minus inflation, and this should be minimum 3 to 4%. So the inflation is around 5% year on year, and the Indian consumer or Indian uh, people expects a savings interest rate of around 8 to 9%. So if this is not the case, he will try to save more as much as he can and completely cut off his investments. So now let's go back to the interest rates. When they are lowered, the assumption was that people will borrow and eventually spend or invest. Now, as we can see, when interest rates are lowered, it severely impacts the interest rate of saving. So this actually means that people will not want to invest. They will want to save more. So this assumption will not work, and the demand therefore will not rise. It will actually fall because he will try to cut down his spending also and ensure that he is protecting his savings. So the demand will actually fall, and when the demand suddenly falls, the the prices are supposed to go down, but when the demand falls, the supply also falls even more steeply, because the moment the demand falls, the suppliers, they immediately stop production. They don't need to, increasing supply takes time, but decreasing supply doesn't take time. They will just stop production or reduce production. So drastically, the supply will fall, and therefore the prices will actually increase in the short term because of the drop in supply. So the prices will increase and there will be inflation, but this inflation will be supply driven and not demand driven. Now, when an inflation is supply driven, then it is actually counterproductive, because both demand and supply are going down, and supply going down means employment going down, and therefore demand and supply going down means the economy goes down. There is no movement in the economy. So this is exactly what we are witnessing right now. So we are seeing that inflation is going up, employment is going down, economy is going down, and supply is going down, and demand is going down. So this is exactly what we are seeing now, and this means that at least in the short term, the economy will not improve. In the short term, economy will stagnate. But what happens in the midterm? Now, after some time, people will probably understand that the interest rates have stabilized at around 5 to 6%. Now, if they have to get an effective saving rate at this 5 to 6%, inflation has to go down. So, in order to drive inflation down, they will start to buy more. They will start to spend more and come back to their normal spending habit, and therefore the demand will start picking up slowly. And the when the demand starts picking up slowly, again we will see a demand driven price rise, and then the usual cycle will come back. Supply will start improving, employment will start improving, and economy will start improving. So when this happens, then we will have a revival of the economy in the mid to long term, and this is at least 2 to 3 years. So then the demand will come back, and the usual cycle will probably follow. But again, the the inflation will play a key role here, and it has to be maintained at around 3 to 4%, so that the effective rate is around 2 to 3% at least. So this is what is the impact of softening of interest rates on the Indian economy, and I think this would give you enough pointers to, to have a discussion in your GD. If you have any questions, please post them in the comment section and I will respond there.